Fixed charges per mile. The fixed charges of a railroad include interest on its bonds, rentals, and taxes, when the last named are not reported with operating expenses. The importance of this figure lies in its relation to net income. If a railroad does not earn well over double its fixed charges, its obligations cannot be regarded as in the first investment rank. Of course, when a railroad earns more than twice the interest requirement upon its entire bonded debt, it is probable that some of the underlying bonds are protected by 3, 4, or 5 times the interest requirement upon them, and their position is correspondingly strengthened. The foregoing analysis applies particularly to mortgage bonds upon the general mileage of a railroad and not to such special issues as collateral trust, terminal, bridge, or guaranteed bonds. It will not be necessary, however, to lay down any rules as to these classes of bonds, for the general principles outlined above, with slight modifications of detail, will be found equally applicable to a judgment of their value. Equipment bonds, on the other hand, owing to their want of similarity to any other railroad issues, will receive separate treatment later. It is of interest, in view of the present diminished confidence in railroad securities, to advance certain considerations touching upon the safety of railroad bonds in general. The last published report of the Interstate Commerce Commission, year 1906, furnishes interesting testimony on this subject. A table on page 60 shows that the total railroad capital of the United States for that year was $14,570,421,478, of which $7,766,661,385, or 53.31%, was in the form of bonded debt and the rest in capital stock. These figures indicate a substantial equity but are somewhat misleading because they refer to par value. A fair estimate of the market value of this stock equity, which is the margin of security in the properties from the bondholder's point of view, can be obtained from a table on page 82, which shows a balance available for dividends after paying all operating expenses and fixed charges of all the railroads of the United States for the year ended June 30, 1906, of $457,060,326. This amount is equivalent to nearly 7% upon the total par value of the stocks. Estimating that a railroad stock should earn 10% upon its market price, and even the most prejudiced will admit that a stock earning 10% is worth par, the total market value of American railroad stocks would be $4,570,603,260, or more than half the par value of the bonds. In other words, the bonded debt should represent something less than 63% of the total market value of the property. This compares favorably with the security of first mortgages upon real estate. When the safety of interest is considered, the showing made is equally strong. Page 82 of the report above quoted shows that the net income of the railroads of the United States for the year ended June 30th, 1906, after payment of all operating expenses, was $848,836,771, and the total fixed charges, including interest on bonds, interest on current liabilities, and taxes, amounted to $391,776,445, leaving a balance available for dividends of $457,060,326. It is apparent, therefore, that the net earnings of the railroads of the United States, considered as one system, could be cut in half, without affecting the payment of interest upon the railroad's obligations. This affords a large measure of protection. The following analysis shows that the actual market value of the railroads is probably greater than the estimate made above. The table shows the percentage of bonded debt to total market value of some of the more important railroad systems. 2 trunk lines in the east, a north and south line in the middle west, and 2 transcontinental have been chosen. No attempt has been made to select railroads which would make a favorable showing. Indeed, Pennsylvania and Union Pacific, by reason of their recent heavy bond issues, probably compare unfavorably with others which might have been chosen. The figures showing the par value of bonds outstanding have been taken from last annual reports, with additions made for recent issues. The figures showing the market value of stocks are based on the amounts outstanding April 1st, 1908 at the market price. Pennsylvania, par value of bonds outstanding $270,974,645. Approximate market value of stock outstanding $361 million. Percentage of bonds to total value 42.8. New York Central, par value of bonds outstanding $255,414,845. Approximate market value of stock outstanding $174 million. Percentage of bonds to total value 59.4. Illinois Central, par value of bonds outstanding $156,053,275. Approximate market value of stock outstanding $120 million. Percent of bonds to total value 56.6. Great Northern, Par value of bonds outstanding, $207,517,939. Approximate market value of stock outstanding, $260 million. Percent of bonds to total value, 44.3. Union Pacific. Par value of bonds outstanding, $274,827,000. Approximate market value of stock outstanding, $324 million. Percent of bonds to total value, 45.9. In view of the enormous decline which has occurred in railroad stocks during the past 18 months, the showing above is truly remarkable. It is plain that the entire bonded debt of any of these standard railroads is less than 60% of the total market value of the property, while in the case of the Pennsylvania, Great Northern, and Union Pacific, more than half of the present market value of the property could be raised before the lien of the bonds least well secured would be impaired. Of course, where the entire bonded debt is protected by such a margin, it is evident that the underlying bonds, the prior liens and first mortgages are protected by several times as great a margin, and their position is correspondingly strengthened. The foregoing analysis in the judgment of the writer affords convincing proof not only that the prevailing want of confidence in railroad obligations is without foundation, but that railroad bonds compare favorably in point of safety with any other form of investment. It remains to point out that the amount of income and degree of convertibility which they afford and the extent of appreciation in value which they promise. It is impossible to do more than indicate the general characteristics of railroad bonds in these particulars. Railroad bonds cover a wide range of income return. They yield all the way from 3.34% to 9%, the general average being from 4% to 6%. As a class, they yield more than government or municipal bonds and less than public utility or industrial bonds. With equal security, they probably yield less than real estate mortgages. Compared with stocks, they return more than bank stocks, average about the same as railroad stocks, and yield less than public utility, industrial, or mining stocks. These comparisons are intended to apply to the classes as a whole and remain generally true in spite of specific cases to the contrary. Convertibility is the distinguishing mark of railroad bonds. Generally speaking, they may be more easily marketed than any other class of bonds. Compared with stocks, they exceed public utility, mining, and bank stocks in point of convertibility and yield only to railroad stocks. It is hard to say whether or not they possess greater convertibility than industrial stocks, but it is probable that they do, allowing for the fact that an undue impression is created by the activity of certain prominent shares. Railroad bonds as a class possess great promise of appreciation in value. American railroads, generally speaking, have adopted the conservative policy of putting a considerable part of their annual earnings back into the property in the form of improvements. To the extent to which the policy is followed, an equity is created back of the bonds, which raises their intrinsic value. This policy contrasts favorably with the general practice of English roads to pay out all their earnings in dividends and to capitalize their improvements. In addition, new capital for American railroads is largely raised by stock issues, which further increases the margin of security for the bondholders. Taken together, these facts ensure a steady enhancement in the intrinsic value of railroad bonds, which is bound to be reflected, other things being equal, in higher prices. We shall not attempt to discuss at this time the degree of stability of market price which railroad bonds enjoy. As explained in the first chapter, stability of market price is dependent upon general financial and business conditions. It is sufficient to point out here that the maintenance intact of the principal sum invested can only be rendered certain by the purchase of short-term securities whose near approach to maturity will keep their price close to par. In a later chapter, the general principles which determine this question will be elucidated. The ideal investment may be defined as one combining ample security of principal and interest, a good rate of income, ready convertibility into cash, and reasonable promise of appreciation in value. Measured by the requirements of this definition, the conclusion seems justified that well-selected railroad bonds, if purchased under favorable money market conditions, afford a highly desirable form of investment.